Hey guys, welcome back to another episode. In this video we will be going through our very simple yet profitable, the CCI zero line cross trading strategy. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. The CCI zero line is a trading strategy that uses the charting of the trading price of an asset to determine the entry point. The strategy uses a short-term time frame, with two long-term commodity channel index, or CCI, and a single exponential moving average. The trade is based upon the CCI crossing over the zero line, while the price is on the correct side of the moving average. The CCI displays the momentum of the price as a value either above or below zero. When the CCI is above the zero line, the price has upwards momentum, and when the CCI is below the zero line, the price has downwards momentum. When the CCI is crossing the zero line, the momentum is switching from one direction to the other. The CCI zero line cross trading system uses this change of direction as its entry point and uses the price in relation to the moving average as a direction confirmation. The default trade uses a 1-hour time frame chart, a 50-bar CCI, a 25-bar CCI, and a 34-bar exponential moving average. The following step-by-step tutorial of the CCI zero line cross trade will use the GBP/US Forex market, but exactly the same steps should be used on whichever markets you are trading with this trade. Step number 1. Open a chart. Open a 1-hour time frame chart. The 1-hour chart offers flexibility in terms of what you want to do. The market moves slow enough for you to be able to analyze the chart for trading opportunities and also generates enough trades so you have lots of decent chances of making money. Also, the size of the stop loss will be much lower than if you were trading the daily chart. Step number 2. Add the CCI and an exponential moving average. The CCI zero line cross trading strategy has a chart configuration with two windows. The first window should contain your favorite market combined with 34-period exponential moving average. The second window should contain the 25-period CCI and 50-period CCI attached to it. In this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Using the CCI as a trend indicator. The Commodity Channel Index, or CCI, is a momentum-based oscillator used to signal the strength of the trend. When a trend exhibits strong momentum, there is a high probability that price will continue rising or falling. In this case, the Commodity Channel Index, or CCI, is a momentum-based oscillator used to signal the strength of the trend. When a trend exhibits strong momentum, there is a high probability that price will continue rising or falling. This means you can expect price to continue in the same direction. So, the next time you want to know how strong the trend of a security is, simply look at what the CCI indicator is suggesting. In this example, you have the 34-period exponential moving average, or EMA, applied to the price chart. When the price rises above the 34-period exponential moving average, it signals an uptrend. When the price falls below the 34-period exponential moving average, it signals a downtrend. To confirm the 34-period EMA trend, we use the CCI indicator. As you can see, the price starts to rise every time the 50-bar CCI and the 25-bar CCI rise above the zero level. And the price starts to fall every time the 50-bar CCI and the 25-bar CCI falls below the zero level. Step number 3. Watch the market. Watch the market and wait until the market is active and moving decisively. Our team at Trader DNA has found out through extensive research that the best trading time is the 8 a.m. Eastern Standard Time to noon overlap of the New York and London exchanges. It's the busiest times during the trading day because there is more volume when two markets are open at the same time. Step number 4. Wait for the zero line cross. Wait until the 50-period CCI crosses the zero line, while the 25-period CCI is on the correct side of the zero line, and the price is on the correct side of the moving average. This means that if the 50-period CCI crosses above the zero line, the 25-period CCI should also be above the zero line, and the price should close above the moving average, and vice versa, if the 50-period CCI crosses below the zero line. If either the 25-period CCI is on the wrong side of the zero line, or the price is on the wrong side of the moving average, that is CCI crosses above, while price closes below the moving average, the trade has not met its requirements and should not be entered. Step number 5. Enter your trade. Enter your trade when the high or low of the entry bar, or the bar when the 50-bar CCI crossed the zero line, is broken by a subsequent bar. As soon as your entry order has been filled, make sure that your trading software has placed your target and stop loss orders, or place them manually if necessary. Step number 6. Watch for the exit signal. In addition to the target and stop loss orders, the zero line cross trade includes an exit and reverse signal. If an entry in the opposite direction is signaled before either the target or stop loss orders have been filled, the trade should be exited and reversed. For example, if the original trade was a long trade, then the new trade would be a short trade, and vice versa. If a new trade is entered, you should make sure that any pending orders from the previous trade have been cancelled, and that new exit orders are placed, either manually or automatically by your trading software. A trade that is exited because of an exit signal can be either a winning trade or a losing trade, depending upon the price at the exit. Here are other examples of the CCI zero-line cross-trading strategy to fully understand this wonderful trading strategy and to make the most out of it. The CCI is one of the best market trend and momentum indicators. The Commodity Channel Index indicator helps traders understand the way a stock, Forex, commodities, and cryptocurrencies moves more easily. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.